Building a sustainable business goes beyond overall profitability. It requires a clear understanding of where profit originates. This insight helps identify and consolidate the products that contribute most to the venture. There's a saying, if your unit economics are broken, scaling the business only scales your losses. This topic bridges the gap between profit per unit and total business profitability, serving as a litmus test for any new product. When introducing a new product, we ask, does it make sense to sell just one unit? If yes, then we ask, how many units must we sell to make the company profitable? In this lesson, we introduce the concept of unit economics and total profit for a business or venture. Let's dive in. Key concepts. What is unit economics? Unit economics refers to the financial profile of a single item, e.g., one sourdough loaf or one packaged cake. It typically excludes overhead costs like rent and salaries to answer one key question. Is this product profitable at its core? The answer guides decisions on whether to continue offering the product. Profit per unit. In professional modeling, profit per unit is viewed from two perspectives, strategic and accounting. 1. The strategic view focuses on the contribution margin per unit, introduced in Module 4. It represents the cash generated by each sale to cover fixed costs. It's called contribution because it helps cover overheads. Once overheads are covered, the remaining amount is pure profit. The formula is unit price minus unit variable cost. 2. The accounting view considers net profit per unit, which reflects the true profit of a single item after allocating a share of overhead costs. This value varies with quantity. For example, if only one loaf is baked, its share of overhead is 100%. If 100 loaves are baked, its share is 1%. The formula is selling price minus variable cost plus allocated fixed cost. Total profit. Total profit represents the overall profit that grows the business capital at the end of a period. It is calculated as contribution margin times units sold minus total fixed costs. Let's now create a dynamic template to capture these concepts. Building the unit economics and scalability template. We will now build a calculator that shows both the contribution margin, which stays constant, and the net profit per unit, which fluctuates with volume. 1. Open the saved Greenleaf Bakery financial model workbook on your device. In the open workbook, navigate to the profit and loss worksheet. We will create the scalability calculator here. You can also create a separate worksheet for the new template. 2. In the Profit and Loss tab, skip 2 columns. In cell G1, type equals unit and scalability analysis, and C2. 3. Create the scenario input. Here we'll retrieve the volume/quantity input from the input sheet, but we'll label it here to show the volume input for the analysis. So in cell G2, type scenario volume. Format cell H2 with a gray color, then cells G1 and G2 appropriately. This is where the retrieved volume in units will be displayed. Four, build the table for the analysis. Follow these steps. A. In row 4 starting from cell G4, enter the table headings in cells G4 and H4 respectively, line item and amount. B. In cell G5, enter profit per unit analysis, micro view. This will form the heading for the unit analysis that follows. C. In cell G6, enter sales price per unit. We'll retrieve this from the product price sheet. D. In cell G7, type variable cost per unit. This will be retrieved from the input worksheet as per the product selected. Format the cells accordingly. E. In cell G8, enter contribution margin per unit. This will be calculated as sales price per unit minus variable cost per unit. F. In cell G9, type allocated fixed cost per unit. This will be calculated as the total fixed cost divided by scenario volume. G. In cell G10, type net profit per unit. This will also be calculated as contribution margin per unit minus allocated fixed cost per unit. H. Skip cell G11. In cell G12, enter the heading Total Profit Analysis, Macro View. This will be the heading for the overall profitability analysis of the business for a selected item's contribution. I. In cell G13, enter Total Revenue. This is the product of the selected item's sales price and the scenario volume, i.e., price times quantity. J. In cell G14, type Total Variable Costs. This will be calculated as variable cost per unit times scenario volume. K. In cell G15, enter total contribution. This will be calculated as total revenue minus total variable cost. L. In cell G16, enter total fixed cost. This will be retrieved from the input worksheet. M. Finally, in cell G17, enter total net profit in bold. This will be calculated as total contribution minus total fixed cost. Five. Apply the necessary functions and formulas in cells H2, H6 to H17 to calculate the amounts and build the dynamic template. A. In H2, enter the formula equals lookup C2 product under TBL hashtag all, comma, product under TBL hashtag all, comma, production volume. This will retrieve the volume of the selected product from the input sheet. B. In H6, enter equals product price, B2. C. In H7, enter equals lookup C2 product under TBL hashtag all, comma, product under TBL hashtag all, comma, total variable cost. D. In H8, enter equals H6, H7. E. In H9, enter equals sum, TBL underscore overheads, slash H2. That is the total fixed cost divided by scenario volume. F. In H10, enter equals H8, H9. G. In H13, enter equals product, H6, H2. H. In H14, enter equals product, H7, H2. I. In H15, enter equals H13, H14. J. In H16, enter equals sum, TBL underscore overheads. K. Finally, in H17, enter equals H15, H16. 6. Format the table accordingly to make it presentable. If there is a need to apply conditional formatting to some cells, apply it to create a visual cue to important cells, especially total net profit and net profit per unit. Seven. Below the table, add a simple break-even check to determine if the product is profitable or not at a glance. So, in cell G19, enter viability check. In cell H19, enter the formula equals if H17 0, profitable, not profitable. This will flag profitable or not profitable, depending on the value of the total net profit. If the value is 0, then we're breaking even. Conclusion. This dynamic template serves as a calculator to determine if a selected product is profitable for the business and identifies the ideal quantity for profitability. Testing different scenario volumes, e.g., 500, 1500, 2500, 3500, will show a constant contribution margin with varying net profit, illustrating that profit per unit depends on product volume. This insight helps guide adjustments to ensure profitability, either by increasing the contribution margin through price changes or by increasing volume to boost net profit. The adjustment to be made depends on the business's area of comparative advantage. Generally, contribution margin tracks the health of the product, while total profit reflects the overall business health. Thank you for staying till the end. If this lesson is helpful, kindly subscribe, like, and share. Stay tuned for scenario analysis.